Geopolitics and the U.S. Dollar's Future as a Reserve Currency. Colin Weiss. Note: International Finance Discussion Papers, IFDPs, are preliminary materials circulated to stimulate discussion and critical comment. The analysis and conclusions set forth are those of the authors and do not indicate concurrence by other members of the research staff or the Board of Governors. Abstract. I survey the role of geopolitics and sanctions risk in shaping the U.S. dollar status as the primary currency used for international reserves. Without changes in the economic incentives for holding FX reserves in U.S. dollar assets, an increased threat of sanctions is unlikely to drastically reduce the dollar share of FX reserves. Currently, around 3/4 of foreign government holdings of safe U.S. assets are by countries with some military tie to the U.S. Even a reduced reliance on the U.S. dollar for trade invoicing and debt denomination by a large bloc of countries less geopolitically aligned with the U.S. would be unlikely to end U.S. dollar dominance. I thank Daniel Beltran, Carol Berteau, Bastian von Beschwitz, Ricardo Correa, Jeffrey Frieden, Daniel McDowell, Carla Norloff, Alexandra Tabova, and Jason Wu for encouragement and helpful comments. Workshop participants at the Federal Reserve provided useful suggestions as well. The views expressed in this paper are solely my own and do not reflect the views of the Board of Governors of the Federal Reserve or anyone else associated with the Federal Reserve System. 1. Introduction. Following bans on transaction with the Central Bank of Russia, Russia's Ministry of Finance, and Russia's National Wealth Fund by the US, UK, and member nations of the European Union, EU, in February 2022, many have questioned how these sanctions will affect the future of the US dollar as a reserve currency. 1. These bans effectively froze assets held by the Russian government in the US and Europe, preventing their use and cushioning the blow of other economic sanctions imposed because of Russia's invasion of Ukraine. In the past 10 years, the US government imposed similar sanctions on assets of the governments of Afghanistan, Iran, Libya, and Venezuela, but the relative size of the Russian economy and the multilateral nature of these sanctions have made them unprecedented. The prominence of the Russian example has thus brought the question of how geopolitics can affect a government's willingness to hold international reserves in US dollar assets to the fore. This paper assesses how a greater emphasis on geopolitical relations may alter the US dollar share of foreign exchange, FX, reserves both over the next few years and the next few decades. Work by political scientists and economists has found an association between geopolitical ties with a reserve currency issuer and that currency's share of FX reserves, as holdings of an ally's assets can serve as implicit support of the issuer's policies or as a means of assuring security guarantees from the reserve currency issuer. Eichengreen, Kitu, Mel, 2019. Iancu et al. 2020. Liao and McDowell. 2016. McDowell, 2021. But, the empirical literature on military alliances and reserve currency status is still relatively sparse, and there remain several open questions. Norloff, 2020. I specifically address two questions related to how geopolitics affect the US dollar's role as a reserve currency. First, to what extent are US dollar FX reserves held by allies of the US? Second, should the world become more stratified along geopolitical lines, what implication would this have for the US dollar's reserve status? I answer the first question using confidential data on individual foreign governments' holdings of US assets from the Treasury International Capital, TIC, data and information on military alliances with the US to separate holdings of US dollar reserves by geopolitical relation with the US government. 2. I find that the majority, 50 to 60%, of safe US assets held by foreign governments are consistently, over the past 10 years, held by countries with strong geopolitical relations with the US. 3. When countries with any form of military cooperation with the US are considered as allies, nearly 3/4 of the US assets held by foreign governments are in the hands of allies. Thus, while US dollar reserves are no longer exclusively held by political allies reliant on US military support as they were from the 1960s through the 1980s, these countries are still the most important set of reserve holders. Halainer, 2008. Kirschner, 2008. I explore the second question considering both the short and the long term. In both cases, the threat to the US dollar's reserve currency status is relatively limited. In the near term, the US dollar's reserve currency status is buttressed both by close US allies, who are less likely to incur sanctions since they receive security guarantees from the US or hold similar political ideals as the US, holding the majority of dollar-denominated FX reserves, and by countries with less formal military ties having strong economic incentives to hold their FX reserves in US dollar assets. These economic motives are likely to remain substantial over the near term, but, over the span of decades, the economic incentives for holding US dollar reserves can change. Thus, when considering long-term ramifications of increased risk of US sanctions and geopolitical fissures, I study a situation where countries without close diplomatic ties to the US move away from using the US dollar as an international currency more broadly. Specifically, I explore a scenario where many emerging and developing economies, EMDEs, cease using the US dollar as the invoicing currency for trade amongst themselves, but instead use the Chinese renminbi, RMB. While a move away from the US dollar in trade invoicing among EMDEs would likely lead to substantial divestment from US dollar FX reserves, the US dollar would still denominate the largest share of FX reserve assets. I arrive at this conclusion first using previous econometric estimates of the relationship between the US dollar share in export invoicing and its share in a country's FX reserves. 4. I also find the same when I use new econometric evidence for export invoicing and reserve currency shares that tries to better address potential non-linearities in this relationship. I conduct a case study of how 6 EMDEs in Eastern Europe shifted away from the US dollar for both export invoicing and FX reserves following the introduction of the euro. The US dollar invoiced a significant but not overwhelming share of these countries' exports prior to the creation of the euro, meaning the estimated relationship between export invoicing and FX reserve composition for these countries over time is likely to be larger than an estimate where the sample is primarily comprised of countries where the US dollar share of export invoicing is either close to 0 or 1. Chin and Frankel, 2008. Finally, I argue this scenario is not the most likely outcome but rather a risk scenario, as facilitating such a large divestment from US dollar reserve assets would require significant changes to the international financial system. The role of the US dollar as the premier reserve currency is one part of broader US hegemony that also encompasses the US having the world's largest economy and its most powerful military. The loss of the US dollar's reserve currency status may thus presage a larger decline in the global power of the US that the US dollar as the dominant reserve currency likely gives the US government, as well as U.S. households and businesses, access to a much larger investor base, enabling them to borrow more than they would be able to if the U.S. dollar was not a reserve currency. This economic advantage allows the U.S. to finance a large and powerful military more easily. Additionally, international use of the U.S. dollar gives the U.S. government another set of tools it can use to achieve its foreign policy aims, along with other soft power benefits. Kirshner, 2008. I add to existing work studying weaponized interdependence and U.S. sanctions risk more specifically by considering how widespread divestment from U.S. dollar reserves might threaten U.S. hegemony. Farrell and Newman, 2019. McDowell, 2021. 5. 2. Geopolitical relations, sanctions, and reserve currency choice. That political factors, in particular geopolitical relations, may affect a currency's status as a reserve currency has been recognized by academics dating back to work by Strange, 1971, and Cohen, 1971. I briefly review the arguments for why geopolitical alliances should help shape reserve currency preferences along with the motives most often studied by economists. Then, I outline how the risk of sanctions on FX reserve holdings undermines the economic motives for investing reserves in a currency and why geopolitical alliances should affect sanctions risk. Countries may wish to hold more reserves in a given currency if they have stronger diplomatic relations with the issuing country for a variety of reasons. Norloff, 2020. While strong diplomatic relations can affect reserve currency compositions multiple ways, I highlight two that are especially relevant for understanding how sanctions risk may vary across countries and thus their reserve currency choices. First, a country may choose to hold its FX reserves in a currency in return for security guarantees from the issuing country. The classic example of this is West Germany continuing to hold US dollars as FX reserve during the Vietnam War as a means of preserving US protection against potential Soviet incursions. Zimmerman, 2003. 6. Second, countries may choose to hold FX reserves in a given currency to signal support for the political aims of the issuing country or as a reflection of preferences for the existing international order. 7. A certain mechanism may matter more depending on the broader economic and political environment of the reserve holder. For example, the security guarantee motive will likely be more important if the country is currently involved in an armed conflict or lacks a possible substitute for a security guarantee from the US. France and Germany are both NATO members, but only France is a nuclear power. Perhaps unsurprisingly, then, Germany consistently holds a greater share of its FX reserves in US dollar assets compared to France. Alignment with US political aims is most likely to matter for countries that are the least aligned with the US. For example, countries that have faced financial sanctions from the US, though not necessarily sanctions on their FX reserves, appear to divest their US dollar reserves shortly after the imposition of sanctions. McDowell, 2021. Notably, this may even have been the case for Turkey, which has a security guarantee from the US through its membership in NATO. In general, the threat of sanctions will affect reserve currency choice because sanctions interfere with the economic uses of FX reserves. Generally, FX reserves are a tool for managing a country's exchange rate and a form of insurance against shocks to international trade and international capital flows. Given the US dollar's dominance in trade invoicing and external debt denomination, as well as its importance as an anchor currency, it is unsurprising that most FX reserves are held in US dollars. Bertaux, von Beschwitz, Kukuru, 2021. Ilzetsky, Reinhardt, Rogoff, 2019. Moreover, the US dollar is supported as a reserve currency because the markets for the US dollar assets held as FX reserves, in particular US Treasuries, are the deepest and most liquid in the world, allowing governments to liquidate their FX reserves in response to negative economic shocks. Brunnermeier et al. 2022. As a result of these significant economic benefits from holding US dollar reserves, even countries without close diplomatic ties to the US may choose to hold US dollar FX reserves. Sanctions impede the ability to use FX reserves as buffers against negative economic shocks. Thus, the threat of sanctions on FX reserves introduces a chance that at least a portion of a country's FX reserve holdings will effectively have zero value in some states of the world. More importantly, it is likely that sanctions on FX reserves will be imposed when the economic benefit of liquidating FX reserves is high. From a portfolio allocation perspective, it is this characteristic of sanctions risk that will especially reduce the optimal share of FX reserves going to a currency where the issuing country may impose sanctions in the future. While the sanctions levied against the Central Bank of Russia may have increased the salience of sanctions risk in the minds of other governments, it is unlikely that the higher risk is felt uniformly across countries. Countries with strong geopolitical relations with the US likely perceive a smaller increase in sanctions risk. As noted by McDowell, 2021, governments under economic sanctions by the US typically are non-democratic, known human rights abusers that have foreign policy preferences that run contrary to US preferences. Indeed, information accompanying the announcement of sanctions on foreign central banks by the US government has referred to threats to US national security, in the cases of Libya, Iran, and Afghanistan, or violation of international law, in the case of Russia. Thus, to the extent that closer diplomatic ties with the US reduce the chances a foreign government threatens US security interests or signal alignment with the US preference for a rules-based international order, they lower the probability of future sanctions. 3. Foreign government holdings of US assets by geopolitical relation. Motivated by the idea that foreign governments with closer diplomatic ties to the US are less likely to face sanctions risk, I break down foreign government holdings of safe US dollar assets by geopolitical relation with the US. To do this, I rely on confidential data on foreign official investor positions in US assets reported in the TIC data. 8. I focus specifically on foreign government holdings of US Treasuries, debt of US government-sponsored agencies, and short-term liabilities of US financial institutions, as these are the US securities most likely to be held as FX reserves. At the end of December 2021, foreign governments' positions in these assets were $5.24 trillion, accounting for about 75% of allocated US dollar reserves captured in the IMF COFR data for 2021, Q4. In understanding the current breakdown of U.S. liabilities to foreign governments by geopolitical alliance, I am particularly interested in what share of total foreign government holdings belong to countries with formal military alliances with the U.S., since these countries likely face the smallest threat of sanctions risk and thus the smallest likelihood of divesting from U.S. dollar reserves in the next few years. 9. For formal military allies, both the security guarantee and political affinity mechanisms discussed above are likely to drive holdings of U.S. assets. In general, countries with formal military alliances with the U.S. also tend to support the U.S.-led international political and economic order, most recently evidenced by most of these countries repeatedly voting to condemn Russia's invasion of Ukraine. I consider two specific formal alliance types. The first and strongest form of diplomatic relationship I examine is a mutual defense partnership with the U.S. 10. The U.S. belongs to three multilateral mutual defense pacts: the NATO alliance with Canada and European nations, the Rio Pact with countries in Latin America, and ANZUS with Australia and New Zealand. 11. The U.S. also has three bilateral mutual defense treaties with Japan, South Korea, and the Philippines. Another form of formal diplomatic tie with the U.S. is that of major non-NATO ally, a designation granted by the U.S. government. Countries that are major non-NATO allies are eligible for cooperation with the U.S. on military projects and granted significant access to U.S. military supplies. Major non-NATO allies without a mutual defense treaty with the U.S. include Singapore, Malaysia, and Thailand in East Asia, and Israel, Egypt, Kuwait, and Qatar in the Middle East. 12. Governments with mutual defense pacts with the U.S. or the designation of a major non-NATO ally accounted for most of the foreign government holdings of safe U.S. assets prior to Russia's invasion of Ukraine. In December 2021, governments of countries in either of these two categories accounted for about 55% of total foreign government holdings of safe U.S. assets. This share has been relatively stable over time as well, as at no point in the past decade has the share held by these countries dipped below 50% or exceeded 60%. 13. Figure 1 plots estimates of the breakdown in actual holdings between the two groups as well as three other sets of countries that will be discussed below as of December 2021. 14. Within this set of close U.S. allies, most holdings are accounted for by governments of mutual defense partners of the U.S. The share held by close U.S. allies is little changed in the initial months after Russia's invasion and the sanctioning of its FX reserves. That said, even among some of these close military allies, political alignment with the U.S. may still affect willingness to hold U.S. dollars at the margin. For example, since Argentina's left wing returned to power in 2019, the central bank's RMB swap line with the People Bank of China has undergone several modifications amidst ongoing economic turmoil. In 2020, the swap line agreement was reportedly renewed without the inclusion of a previous clause requiring adherence to Argentina's IMF program, while the size of the swap line was increased in 2022. 15. In Brazil, a rise in the U.S. dollar share of FX reserves has broadly coincided with the presidency of Jair Bolsonaro, who is viewed as a stronger supporter of the U.S. than his predecessors, Banco Central do Brazil, 2021. I will return to the importance of political alignment with the U.S. for holding U.S. dollar reserves in Section 4. Additionally, many countries without a formal military alliance with the U.S. have military ties to the U.S. either via recent imports of military equipment and weapons from the U.S. or participation in joint military exercises with the U.S. These ties may prevent these countries from taking actions that upset U.S. policymakers and raise the probability of sanctions. As suggested by Figure 1, a non-trivial amount, between roughly 15 and 20% of the total held by foreign governments, of safe U.S. assets are held by countries that receive some form of military support from the U.S. but lack a formal alliance. 16. India, Hong Kong, Vietnam, Indonesia, Saudi Arabia, the United Arab Emirates, and Mexico comprise the largest holders among this group of countries. Even if the governments of these countries perceive an increased risk of sanctions being imposed on their U.S. dollar FX reserves, it is likely the economic benefits of continuing to hold U.S. dollar reserve assets will outweigh the extra costs associated with higher sanctions risk, at least in the near term. To see this, consider four of the largest holders that do not have a mutual defense pact or a major non-NATO ally designation. Hong Kong's linked exchange rate system, LERS, establishes a currency board for the Hong Kong dollar, rigidly pegging its value to that of the US dollar. The LERS also stipulates that the Hong Kong Monetary Authority keep at least 80% of its liquid FX reserves in US dollar assets, limiting its ability to divest from US dollar reserves. Currently, Hong Kong holds about 90% of its FX reserves in US dollar assets, Iancu et al., 2020. Saudi Arabia and the United Arab Emirates also peg their exchange rates to the US dollar since each country has a prominent oil exporting sector and global oil sales are typically invoiced in US dollars. This feature itself is a product of US security guarantees for Saudi Arabia. See Croteau and Post, 2020. Mexico has extremely strong trade linkages with the US, as about 70% of Mexico's merchandise exports went to the US and 45% of Mexico's merchandise imports came from the US over the 2016 to 2020 period. The costs of divesting from US dollar reserves would thus be substantial for these countries barring some change in their economic structures. Figure 1 also reports estimates for 2 additional groups of countries unlikely to divest substantially from US dollar reserves for differing reasons. The first set of countries is Finland, Ireland, Sweden, and Switzerland. These are countries that have historically remained neutral in major armed conflicts and shunned formal military alliances, though Sweden and Finland will soon join NATO. More broadly, these countries tend to support the existing international order and thus face limited risk of sanctions from the US, as even Switzerland agreed to enforce sanctions against Russia. The final set of estimated government holdings displayed in Figure 1 is for China. China maintains the largest stockpile of FX reserves, and the RMB is frequently identified as the most likely future challenger to the US dollar's reserve status, with China the biggest competitor with the US for the role of global hegemon. At the same time, China's ability to substantially lower the US dollar's share in its FX reserves is limited in the near term. 17. Markets for safe assets denominated in other major reserve currencies lack the size and depth necessary to accommodate China's massive FX reserve holdings, and the other major reserve currencies likely present similar geopolitical risk as the US dollar since the issuing countries are close US allies. 18. Notably, at least 94% of allocated FX reserves in 2021 Q4 were held in currencies of countries participating in the Russian sanctions according to COFER data. 19. But China's sizable FX reserves mean that even somewhat small decreases in the US dollar share of their FX reserves may result in large sales of US assets in absolute terms. 4. How geopolitical risk may threaten the dollar's status over the long run. A. Scenario description. As the preceding section argues, without changes in the economic incentives for holding FX reserves in US dollar assets, an increased threat of sanctions is unlikely to drastically reduce the dollar share of FX reserves. This section lays out one scenario where the economic benefits of US dollar reserves decline for countries less aligned geopolitically with the US and analyzes the implications for the dollar's share of FX reserves. At the root of this change is a reduction in the use of the US dollar for trade invoicing by countries that are less aligned with the geopolitical aims of the US. Recent work by Gopinath and Stein, 2018, 2021, argues that the use of a currency for trade invoicing and for denominating liabilities creates incentives for a government to hold this currency in its FX reserves. Additionally, it has recently been reported that countries with diplomatic disagreements with the US may be negotiating with China to accept RMB for their commodity exports to China, adding to the relevance of such a scenario, though US dollar reserve divestment could occur through ways not addressed here. 20. The relatively undeveloped international payments network for transactions settled in RMB and China's strict capital controls limiting both inbound and outbound capital flows mean that such a scenario would most likely need to proceed gradually, if it were to occur at all. 21. A larger number of financial institutions would need to participate in China's cross-border interbank payment system, CIPS, to facilitate wider use of the RMB in trade invoicing. The limits on outbound portfolio investments by Chinese residents would need to be relaxed to create deeper markets for foreign liabilities denominated in RMB. Similar conclusions are reached by Ike and Green, 2022. According to Gopinath and Stein, 2018, this would create incentives for foreign governments to hold RMB assets as FX reserves, and this in turn would likely require foreign investors to be able to hold greater amounts of Chinese assets than at present. Given these possible constraints on RMB internationalization, a reasonable sequence of events would be for China to first pay for its imports, particularly of commodities, from countries not aligned politically with the US in RMB while developing the RMB cross-border payments network, relaxing capital controls, and strengthening property rights for investors. 22. Should this first stage prove successful, the next step would be for the same set of non-Western aligned countries to use the RMB more broadly with each other. At the same time, broader use of the RMB in trade invoicing would enhance the attractiveness of issuing RMB-denominated liabilities and holding RMB assets in these countries. This would likely occur at the expense of the US dollar, which is used to invoice almost all trade outside the euro area and denominates most external liabilities for EMDEs. The key choice for designing this scenario is which countries would be most likely to reduce their reliance on the US dollar as an international currency. I argue the countries with the greatest probability of diversifying away from the US dollar are EMDEs in Africa, Central Asia, Latin America, and the Middle East. These countries often lack formal military alliances with the US, and even those that do, such as the nations of Latin America, have also established growing relations with China and Russia. 23. In general, governments in these regions appear unwilling to fully pick sides in disputes between the US and its closest allies, and China. Al-Tamimi, 2019. Mazzocco, 2022. As a recent example, these governments have generally walked a fine line diplomatically during the recent Russian invasion of Ukraine, sometimes offering humanitarian assistance to Ukraine but refusing to outright condemn Russia's actions, placing them closer to China's position on the issue relative to the stance of the US and its allies. 24. Thus, I regard political alignment as the more important mechanism for linking diplomatic alliances to reserve currency composition for these countries, especially as there is a greater possibility of substituting away from US military support over a longer time span. One notable set of countries that I do not initially consider as likely participants in this scenario are the nations of Southeast Asia. While these countries have stronger economic ties with China, they have stronger military and diplomatic connections with the US. Lin et al. 2020. Moreover, holding RMB-denominated reserve assets may be a risky venture for these countries due to ongoing territorial disputes in the South China Sea. Stromseth, 2019. Therefore, for Southeast Asian nations, I treat military support from the US as the more relevant geopolitical mechanism for influencing holdings of US dollar FX reserves. B. Estimated US dollar reserve divestment. Should many EMDEs choose to reduce their use of the US dollar in trade invoicing for geopolitical reasons, how much would the US dollar share of FX reserves be expected to decline? I provide one answer here using existing estimates of the relationship between the dollar's share in export invoicing and its share in FX reserves for a given country. Studies by Arslanalp et al. 2022, and Ito and Macaulay, 2020, find a 1 percentage point fall in the dollar's invoicing share of a country's exports is associated with a 0.2 to 0.5 percentage point fall in the dollar's share of that country's FX reserves. I apply the upper point estimate of 0.5 to changes in the dollar's export invoicing share for 43 of the largest holders of FX reserves in Africa, Central Asia, Latin America, and the Middle East. 25. Equation 1 above outlines the calculations I perform for each country, in the sample and then sum across countries. I first use bilateral export data from UN Comtrade for the 2016 to 2020 period to compute the share of exports that go to non-Western countries for each of the 43 countries in the sample. Non-West export, 26. Specifically, I assume that all merchandise exports to countries outside of NATO, the EU, neutral Europe, Japan, Korea, Australia, New Zealand, and the member nations of the Association of Southeast Asian Nations, ASEAN, switch from being invoiced in dollars to invoiced in RMB. This non-Western export share is multiplied by country I's FX reserves in 2021, reserves, as well as the 0.5 estimate from the previous literature on the relationship between the currency composition of export invoicing and FX reserves. 27. I then divide by global FX reserves, global reserves, at the end of 2021 as reported in the IMF COFER data and sum up across countries. Thus, the only limit to how much these countries are predicted to diversify away from US dollar reserves is how much they export to non-Western countries. Under this proposed scenario, the US dollar share of FX reserves would decline by 6.2 percentage points or $800 billion using current FX reserve levels. Figure 2 shows the breakdown by region, with the two countries with the largest predicted US dollar divestments separated out. The two largest diversifiers, Saudi Arabia and India, account for more than 40% of the predicted divestment, and the three largest diversifiers account for 53% of the predicted divestment from US dollar reserves. Saudi Arabia is the largest diversifier due to its sizable stockpile of FX reserves, currently around $430 billion, and the small share of exports directly allocated to Western countries, less than 10%. 28. The most important regions in terms of US dollar divestment are the Middle East and Latin America. The predicted divestment from US dollar reserves for these 43 countries would not cause the US dollar to lose its majority status among FX reserve currencies, but, when combined with realistic divestments from 2 other countries, it would. The first additional divestment would come from China. China's desire to diversify its reserves away from the US dollar is an open secret, and while its ability to shift its FX reserves into other currencies is severely limited in the near term, this is unlikely to be the case over the course of a decade or 2. I draw on 2 pieces of information to create a prediction for China's dollar divestment. First, Shang, 2013, estimates that China increased its euro share of FX reserves by 15 percentage points between 2000 and 2005, largely at the expense of the US dollar share. Second, while China was able to reduce its dollar share of FX reserves relatively quickly then, doing so over the coming years will be considerably more difficult. 29. Therefore, I assume here that China reduces the dollar share of its FX reserves by 10 percentage points or about $320 billion. The second additional divestment I consider would come from Hong Kong, which has felt the threat of Western sanctions in recent years resulting from tighter control of the region by China. 30. Should Hong Kong abandon its LERS due to these fears, adopt trade invoicing patterns like other non-Western countries, and allocate its reserves based on these patterns, it would be predicted to divest $170 billion from US dollar reserve assets. These 2 additional sources of divestment, in combination with the sales of US dollar reserves by the original 43 sample countries, would reduce the US dollar share of FX reserves by 10 percentage points or $1.3 trillion at current levels of FX reserves. Given the US dollar's 59% share of FX reserves in 2021, Q4 according to COFR data, this would mean the US dollar would no longer comprise the majority of reserves. C. Is the predicted US dollar reserve divestment realistic? The estimates of divestment from US dollar reserves under a switch away from US dollar export invoicing I report are based on one estimate from one study. Thus, it is worthwhile to check the robustness of the estimates to different assumptions. First, I assess potential sources of bias in the calculations. I may overestimate US dollar divestment in this scenario because I use the largest estimate from previous work. I assume all trade between non-Western countries is invoiced in US dollars, and, while firms and governments might be comfortable accepting the RMB for trade purposes, governments may not be as willing to hold RMB assets as FX reserves. I may also underestimate US dollar divestment in this scenario because the relationship between reserve currency share and export invoicing share may be nonlinear. The shares of exports to non-Western countries are likely to grow in the coming decades, and countries switching their invoicing currency may divest from US dollar reserves for geopolitical reasons independent of the switch in invoicing currency. I consider the possibility of a nonlinear relationship between reserve currency share and export invoicing currency use as the consideration that most requires further investigation. In the presence of network externalities and economies of scale, as is almost surely the case for reserve currency use, linear regression will fail to account for a higher derivative reserve currency share with respect to the determinant variable when the determinant is further away from its extreme values. Chin and Frankel, 2008. Moreover, according to Boz et al., 2022, most EMDEs either invoice the vast majority of their exports in US dollars or hardly at all, suggesting a linear regression of reserve currency shares on export invoicing shares may underestimate the effect for some large changes in invoicing currency share. The scenario described above would indeed result in large changes in invoicing currency use. As shown in Figure 3, 30 out of the 43 countries studied would have the US dollar share of both export and import invoicing change by over 40 percentage points. Included among these 30 countries are 5 of the 7 countries in the sample with FX reserve holdings greater than $100 billion. Additionally, part of this tipping phenomenon may reflect how invoicing currency use may influence other factors affecting reserve currency share, such as the choice of anchor currency for exchange rate movements. Igorov and Mukin, 2021. I overcome the issue of nonlinearity by studying the coevolution of the US dollar share in FX reserves and export invoicing for 6 EMDEs in Europe following the creation of the euro. 31. Prior to the creation of the euro, Bulgaria, Croatia, Latvia, Lithuania, North Macedonia, and Romania each had non-trivial US dollar shares in export invoicing and reserve currency allocation, with both typically between 30 and 60%. As shown in Boz et al. 2022, the US dollar share of export invoicing typically fell to single digits in the 20-year period after the euro's creation. Further, the change in the US dollar share of FX reserves is larger than the change in the dollar share of export invoicing over the 2000 to 2018 period for 4 of the 6 countries, as shown in Figure 4. 32. I confirm this pattern in a panel regression of the US dollar share in FX reserves on its share in export invoicing from 1999 to 2019 for those 6 European countries that includes country fixed effects. 33. To help make my results comparable to those in Ito and Macaulay, 2020, I do not use annual observations but 3-year, non-overlapping averages of each variable. I find that a 1 percentage point change in the US dollar's export invoicing share is associated with a 1.1 percentage point change in its share of FX reserves, as shown in Table 1. This is a substantially larger estimate than almost any estimate found in previous studies. 34. This suggests that widespread adoption of the RMB for trade invoicing would lead to greater changes in the US dollar share of FX reserves than estimated in Section 4. B. 35. Based on my estimate reported in Table 1, I create an alternative set of predicted US dollar reserve divestments for countries that would experience a large shift in their trade invoicing patterns. Specifically, for countries with non-Western export and import shares greater than 0.4, I replace the 0.5 in equation 1 with 1, so that, for every percentage point decline in the US dollar share of export invoicing, there is a percentage point decline in the US dollar share of FX reserves. For all other countries, I continue to use the original form of equation 1. The predicted decline in the US dollar share of FX reserves nearly doubles relative to the 6.2 percentage point decrease estimated in Section 4. B. Using these alternative assumptions, the predicted fall in the US dollar share of FX reserves is now 11.8%. Figure 5 indicates that most of the larger divestment results from the new estimate being applied to the 3 largest divestors, Saudi Arabia, India, and Brazil. If, as is done in Section 4. B, I also assume that China reduces the US dollar share of its FX reserves by 10 percentage points and Hong Kong abandons the LERS and uses the RMB for invoicing non-Western trade, the predicted decline in the US dollar share of FX reserves increases to 17%. The international monetary system would be much more multipolar, but the US dollar would remain the dominant pole, with a share of FX reserves still more than double that of any other currency. D. Risk scenario rather than modal outcome. I consider the scenario of a widespread, geopolitically motivated shift away from the US dollar in trade invoicing and in turn FX reserves not to be the most likely outcome over the coming years. Rather, the geopolitically motivated shift away from the US dollar as an international currency is a risk to the most likely outcome where the US dollar retains its dominant role in trade invoicing and FX reserves for all countries. It is thus worth reviewing the arguments for why this is the case. These arguments underscore how many different factors would have to go a certain way for the US dollar's dominance to be substantially diminished. First, as discussed in Section 4. Such a scenario becoming reality likely requires substantial changes in China's capital account policies, major developments in the infrastructure required to support cross-border transactions denominated in RMB, and broader structural reforms to Chinese debt markets. It may simply be a matter of time for China's cross-border payments infrastructure to develop, but the other two factors are much less certain. To date, the Chinese government retains tight control over capital flows, especially on flows into foreign assets by Chinese residents. The government relaxed some of these restrictions in 2021 to encourage outflows by Chinese residents, though the timing of these changes suggests they were done to help stem appreciation pressures on the RMB at the time. Without further removal of capital controls, it is unclear whether there would be a large enough investor base to entice foreign entities to issue liabilities denominated in RMB that would in turn incentivize governments in these countries to hold RMB-denominated FX reserves. In addition, Increasing both FX reserve demand for RMB-denominated assets and the willingness of foreign entities to issue RMB-denominated assets will likely require structural changes to Chinese bond markets. As one example, a lack of transparency for the default resolution process for Chinese local currency bonds remains a key sticking point for foreign investors. 36. In addition to the developments necessary in China, this scenario would also require major changes in many of the countries switching to RMB trade invoicing beyond the invoicing currency adjustment. Consider the two largest divestors of US dollar FX reserves in the scenario, Saudi Arabia and India. For Saudi Arabia to hold substantial amounts of RMB-denominated FX reserves, it would surely have to end the rial's peg to the US dollar. If only some of the non-Western countries switch to RMB invoicing, the incentives for Saudi Arabia to abandon its dollar peg are much smaller. In the case of India, it would mean greater political and economic cooperation with a country that it faced in minor military skirmishes as recently as 2020. 37. India could easily decide the economic benefits of RMB invoicing and RMB FX reserves are not worth the geopolitical risks, especially if not all non-Western countries begin invoicing in RMB. Moreover, for Saudi Arabia and India, their economic size means that their decisions about invoicing currency would likely affect the invoicing decisions of other non-Western countries. 5. Conclusion. Although the sanctions imposed on Russia's FX reserves by the US and its allies may have increased the salience of sanctions risk, I find that geopolitics alone are unlikely to end the US dollar's dominance as a reserve currency. Most government holdings of U.S. assets belong to those with close military ties to the U.S., and countries without these ties have strong economic incentives to hold dollar-denominated reserves. Even a geopolitically motivated move away from the U.S. dollar in trade invoicing would only diminish the dollar's role as a reserve currency and not destroy it. U.S. hegemony is thus unlikely to end from a loss in the dollar's reserve currency status. That said, two caveats need to be applied to this relatively sanguine conclusion. First, it relies on the U.S. maintaining its current diplomatic alliances, which is not guaranteed. Second, I have only considered whether geopolitics can end dollar dominance. There may be other factors that also reduce the U.S. dollar's share over time, such as the deepening of financial markets in non-traditional reserve currencies. Arslanalp et al. 2022. Finally, future work should further explore the specific mechanisms through which close diplomatic ties may lead to larger holdings of U.S. dollar reserves.